Today we will discuss Unit 6 of International Financial Management that is related to currency derivative contract, currency forward contracts, currency futures contract, currency options contract and currency swaps contract. So before starting my class, let me first tell you what is the objective of my class. First, we will discuss and understand how derivative instruments work. Then we will understand the meaning and use of currency derivatives, that is currency future, options, swaps. The structure of my discussion will be like this. First, I will give an introduction to the subject. Then we will discuss derivatives and currency derivatives. Next, we will discuss application of currency derivatives. Next, we will discuss hedging techniques, long hedge and short hedge. Next, we will discuss currency options, currency swaps. We will discuss some keywords and self-assessment questions and further reading. Now, what is a currency? We know that currency is a medium of exchange. Currency is a medium of exchange. In India, Indian currency is known as INR. In USA, their currency is known as USD. So currency is a medium of exchange. Currency market is a market where different type of currencies are traded. And this trading is done with the help of banks and authorized dealer. So currency market are those market where buyers and seller trade currency with each other through bank or through authorized dealer. We know that currency market is the most actively traded market in the world. The trading occurs, daily trading occurs in trillions of dollars. Okay, the currencies normally are traded in pair form. In currency market, pair trading takes place. What is pair trading? Pair trading means currency are traded in pair, like USD INR. Okay, in this case, two currencies are traded at a time. One currency is known as base currency and the other currency is known as quote currency. Let's take an example. $1 is equal to rupees 80. In this case, dollar is base currency and rupee is quote currency. The dollar value is quoted in term of rupees. The base currency value normally does not change, but the quote currency value goes on fluctuating. It may go on increasing or it may go on decreasing. Like $1 may be rupees 85, $1 may be rupees 75, $1 may be rupees 70, $1 may be rupees 95. The value of currency, which currency, quote currency changes, but the value of base currency remains constant. Okay. Normally, in currency market, a player is there who is known as market maker. Who is a market maker? Market maker is a person which provide two-way quote. What is two-way quote? One is he is ready to buy and he is ready to sell. Which currency? Base currency at a rate. The rate at which he is ready to buy base currency is known as his bid rate. So bid rate is the rate at which market maker is ready to buy base currency. And the rate at which he is ready to sell the base currency is known as ask rate. So there are two type of rate, bid rate and ask rate. So if $1 is equal to 80, 82, in this case 80 is the bid rate and 82 is the ask rate. Always ask rate is more than bid rate. The difference between bid rate and ask rate, in this case it is 2 rupees. This 2 rupees is known as bid ask spread. Sometimes currency value is directly find out, but sometimes we cannot have direct value of a currency. In that case, we have to calculate the exchange rate in an indirect way by taking a third currency as base, and that rate is known as cross exchange rate. So cross exchange rate is calculated with the help of a third currency. Let's take an example. One currency is Indian currency INR, another is Cambodian dollar. INR, Cambodian rupees. Cambodian rupees. How we can find out the value? We can find out the value with the help of a third currency, that is US dollar. Because US dollar is the common currency which is bought and sold in India as well as Cambodia. That is known as cross exchange rate. The currency market may be of two types. One is known as interbank market, another is known as merchant market. What is interbank market? Interbank market is the wholesale market of currency. In this case, who are the players? The players are different. Financial institutions are the players. They play in this interbank market, or where different financial institutions buy and sell currencies between themselves. Another portion of currency market is retail market, that is known as merchant market. In merchant market, retail participation is allowed between buyer and seller. Okay, normally the merchant rate is more expensive than the interbank rate, or merchant rate is more than interbank rate. Next, in the world, there are two systems of exchange rate regime. One is known as fixed exchange rate, another is known as floating exchange rate. On the fixed exchange rate, the government decides the exchange rate. It fixes the value of the rate with some internationally accepted currency, that is known as pegged rate. It peg it currency to a particular currency. Normally, US dollar, many countries peg their currency value to US dollar. In this case, government decide the rate. Okay. In this case, the fluctuation in exchange rate is is not so frequent. Okay, after a regular period, the country may revise the rate if fixed exchange rate. The revision in fixed exchange rate may be in form of revaluation or devaluation of currency. It may increase the value of the home currency, that is revaluation. The government may decrease the value of the home currency, that is known as devaluation. Many small countries of the world like Aruba, Bahamas, Barbados, Bermuda, they adopt fixed exchange rate. But most of the major countries of the world follow floating exchange rate. What is floating exchange rate? Floating exchange rate is a system of exchange rate where exchange rate is decided on the basis of demand and supply and demand of currency. Okay, the floating exchange rates are followed most of the countries like British, Euro, Japan. They follow US. They follow floating exchange rate. In case of floating exchange rate, the fluctuation in exchange rate is very frequent. So in floating exchange rate, there is frequent appreciation of currency or frequent depreciation of currency. Currency value changes very fast in case of floating exchange rate because it is traded in the market and the rate is decided by demand and supply. If there is excessive demand pressure or buying pressure, the currency value will increase. If there is excessive selling pressure, the currency value will decrease. Okay, so there will be a wide fluctuation in the value of the currency in case of floating exchange rate. If there will be fluctuation in the value of the currency, it will give a risk for importer and exporter. That risk is known as exchange rate risk. So what is the exchange rate risk? The exchange rate risk is the risk which is faced by both importer and exporter of a country due to fluctuation in its exchange rate. Okay, that is known as exchange rate risk, or it is also known as currency risk. Let's take an example of currency risk. Suppose a Indian company has placed an order to import specialized machinery worth 5 lakh dollar from Germany. So it has given an Indian importer has given an order and it has to purchase the machine worth 5 lakh dollar and has paid a small advance of $10,000 now. So rest 4 lakh $90,000 here payment has to be made. When the payment has to be made, the payment has to be made after the credit period. Credit period. Suppose the credit period is 3 months. So after 3 months, the company has to pay 4 lakh 90,000 US dollar. Suppose today the US dollar value is 75, but after 3 months it becomes 80. So you have to pay, the Indian importer has to pay 5 rupees extra for each dollar. For 4 lakh $90,000, it has to pay 4 lakh 90,000 into 5. That much extra amount it has to pay, and this extra amount which it pay in term of Indian rupees results in foreign exchange risk or currency risk or exchange rate risk. Similarly, suppose there is an Indian exporter, it has to receive 1 lakh dollar. Indian exporter export goods worth 1 lakh dollar to a buyer in Middle East. Okay, the payment is to be received after 3 months. Okay, but today exchange rate is 1 rupee is equal to $1 is equal to 78 rupees. But after 3 months it reduces to 75. If it reduces to 75, then what happens? 73 rupees less it received per dollar. In $1,000, it received 3 lakh rupees less, and this 3 lakh rupees is the currency risk for the Indian exporter. Okay, so currency risk exists. Okay, when the domestic currency value increases or decreases, or if there is appreciation or depreciation of a currency in comparison to other currency, then in that case what happens? The currency risk exists. Okay, you know, appreciation of rupee is good for importer. If you are in an Indian importer, you always think that the Indian rupee value must appreciate, so that you have to pay less. But it is harmful for exporter. Exporters thinks that rupee value must depreciate. If it appreciates, exporter receive less. On the other hand, depreciation of rupee is good for exporter. Exporter always want the rupee value must depreciate, but it is detrimental to importer. Okay, so in case of floating exchange rate risk, both importer and exporter face exchange rate risk or currency risk, because they have to receive or pay foreign currency on a future date. Okay, on future date the currency value may increase or decrease. On the basis of that, they face currency risk, and this type of currency risk can be managed with the help of derivative instruments, and that derivative instruments which is used in managing currency risk is known as currency derivatives. So in today's class we will discuss details regarding currency derivatives. What is currency derivatives, how it is used, what are the varieties of currency derivatives, where currency derivatives are purchased and sold. We will discuss in detail regarding currency derivatives. So first, before discussing currency derivative, let me first give you an example of derivative. What is a derivative contract? Derivatives are financial contracts. Derivatives are financial agreements, and derivatives are agreements between buyer and sellers. And the derivative instruments do not have any independent value. They derive their value from the value of the underlying asset. Hence, a derivative contract is used to fix the future buying price or future selling price. Derivative instruments are used for fixing buying price and selling price today. So, of what? Of the underlying asset. Without an underlying assets, there cannot be any derivative contracts. Derivative contracts derive its value from the underlying assets. These underlying assets can be equity share, commodities, currencies, or any other asset which has commercial value. There are four basic type of derivatives. What are those? One is forward contract, another is future contract, another is option contract, another is swap contract. Forward contract, futures contract, option contract, and swap contract. These are the four basic type of derivative contract. What are the four type of derivative contract? Forward, futures, options, swap. These are basic derivatives. What is basic derivative? Four basic derivatives are there. One is forward contract. Second one is futures contract. Third one is options contract. Fourth one is swap contract. Forward, future, option, swaps. These are four basic derivatives, and we will study in details these forward, future, option, swaps in context of currency. So hence, those are known as currency forward, currency future, currency options, and currency swaps. And those are known as currency derivatives. So what is currency derivative? Currency derivatives are derivative contracts with which a currency pair is the underlying asset. So currency derivatives are those type of derivative contracts where a currency pair is the underlying asset. Dollar derivative, dollar forward, euro forward. A currency pair, dollar and rupee rate will be fixed now. Future, it can be future buying rate or it can be future selling rate. It will be fixed now. Hence, a currency derivative is a contract through which a buyer and seller agree today on the rate at which they will exchange a fixed amount of currency on a fixed future rate. It means with the help of currency derivatives, we can prefix the future buying price or future selling price of a currency. Okay, there are four varieties of currency derivatives. One is currency forward, another is currency futures, next one is currency options, next one is currency swaps. These are four basic type of derivatives: forward, futures, options, swaps. Out of which the forwards and swaps are privately traded contracts. These are privately available contracts. These are not purchased and sold in market. These are privately traded contracts. Which are privately traded? Forward and swaps. What is purchased in the market or in the market? These two instruments are available: futures and options. These are normally exchange traded contract. So in the market, you will find out currency future and currency option. Combinedly, that is known as futures and options, or futures and options, or which is known as F and O market. Currency futures and options. Currency F and O. So we will discuss in details regarding what is forward, what is future, what is option, what is swap, we'll discuss. So in India, currency derivatives started trading in Indian exchanges from August 2008. First currency futures were traded in NAC, National Stock Exchange. Right now, in these three platforms, currency trading are taking place. NAC, National Stock Exchange, BSE, Bombay Stock Exchange, MSC, Metropolitan Stock Exchange, where currency are bought and sold. What are different mostly active traded currencies in India? In India, following currency pairs are purchased and sold maximum. One is USD INR, US dollar. Next one is Euro INR, Euro in term of INR, JPY INR, Japanese yen in INR, GBP INR, that is Great Britain pound INR. In this case, INR is the core currency. But there are certain cross currency pairs which are also traded in India. Those currency pairs are Euro USD, GBP USD, USD JPY. These are three most popular cross currency pairs traded in Indian market. When there is currency trading, the settlement has to be made. Settlement are of two types. One is physical settlement, another is cash settlement. There are two types of settlements. What are the settlements? One is physical settlements, another is cash settlement. Physical settlement, another is cash settlement. In case of physical settlement, the payment is to be made through delivery of currency. Here, actual delivery exists. Delivery of underlying exists. But in case of cash settlement, there is no delivery of underlying. Only amount raised, amount, a cash difference is settled. No delivery of physical assets. Only profit or loss settled in cash. So currency futures in India are cash settled. In India, most of the currency futures are cash settled. Physical settlement does not exist in India. It is not physically settled. Okay. So we have discussed regarding different currency derivatives. Next, we'll discuss regarding participants in derivative market. Who are the major participants in currency derivative market? Normally, there are three major participants in currency derivative market. One is known as hedgers, another is known as speculator, another is known as arbitrator. So there are three players in currency derivatives market. One is hedgers, another is speculator, another is arbitrator. Who is a hedger? Normally, a hedger is an importer or exporter. He enters into derivative market for the purpose of hedging, for the purpose of fixing his future buying price or future selling price. So hedger enter into derivative market to protect their position, to minimize their risk. Their main purpose is not to make profit but to minimize the risk. Hedger always wants to transfer the risk, and with the help of derivative instruments, they transfer their risk to another hedger or to a speculator. So hedgers in derivative market protect their positions to enter their positions to protect their positions and not to make profit from this market. Okay. Hedgers are interested to transfer the risk to those parties who are willing to accept it. So, in a derivative market, who is willing to accept the risk? Another party is there. His name is speculator. Who is a speculator? Speculator is a person who has a direction, who has a view on future direction of exchange rate movement. He is ready to accept the risk He is ready to accept the risk in anticipation of making profit from his view. If his view is correct, then he will make money. If his view is not correct, he will lose money. In case of derivative, the hedgers never lose money because he has not come to make money. He has come to reduce his risk. He has come to fix the future buying price or future selling price. But the speculator will gain or lose in case of which market? In case of derivative market. Because speculators enter into derivative market with the aim of making profit. So he can make profit if his view is correct, and he will lose money if his view is not correct. Okay, speculator provide liquidity to the derivative market. If there is no speculator, there will be very less liquidity in that instrument. Okay, so hedger transfer the risk, speculator accept the risk. Hedger cannot make profit, speculator makes profit or loss. Hedger does not incur loss, speculator incur loss. Hedger's main motive is to fix future buying price and selling price. Speculator's main motive is to make profit or loss. Next set party who are there in derivative contract, that is known as arbitrator. We are know what is arbitrator. Arbitrator is the third party. They simultaneously buy and sell in two different markets. If a arbitrator see that same commodity in two markets are sold in two different price, arbitrator will enter into picture. He will buy in a low priced market and he will sell in a high priced market. As a result of which he will make some riskless profit. So the main aim of arbitrator is to lock in riskless profit. How he make lock in riskless profit? By simultaneously buying in cheaper market and selling in expensive market. Arbitrator, if there is arbitrator, they make ensure that prices in markets remain arbitrage free. Arbitrage opportunity happens for a few seconds, few moments, and arbitrator with the help of sophisticated trading instruments like algo based trading take the benefit of arbitrage and make some profit. Next is different type of positions taken in derivative market. In derivative market, you can take two positions. What are the two positions? One position is known as long position. Another position is known as short position. So what is a long position? What is short position? Long position means you agree to buy. So buyer take long position. Who take long position? Buyer of a derivative contract take long position. And who takes short position? So short position in which you agree to sell. So who takes short position? The seller takes short position. Okay. So in derivative contract, there are two type of position: long position and short position. Long means buyer, short means sell. Okay. Buyer holds long position, seller holds short position. Am I clear? Next. Now we will discuss regarding application of currency derivatives. I have told that derivative is a risk hedging tool. Derivative is a risk hedging mechanism. With the help of derivative contract, one can prefix the future buying price or future selling price today. Okay, so in future, whatever might be the price, you will buy at the agreed price or you will sell at the agreed price, and the future, uncertain future, becomes certain with the help of derivatives. So first we will discuss the application of currency forward contract. Before discussing currency forward contract, let me first tell you what is a forward contract. A forward contract is a bilaterally traded contract. What is bilateral traded contract? In a forward contract, there are two parties. One is buyer, another is seller. There is no intermediary between buyer and seller. There are only two parties, buyer and seller. Buyer takes long position, seller takes short position. Okay. The forward contracts are customized contracts. These are tailor-made contracts. The term and conditions of forward contracts are decided between buyer and seller. No other party dictate the term and conditions of forward contract. So a forward contract is a bilaterally traded, customized contract between two parties. Who are the two parties? One is buyer and seller. And the contract is either to buy or sell a fixed quantity of underlying asset. The contract is to buy or sell an underlying asset. At what price? At a specified price. This is known as agreed price. So in a forward contract, there is a fixed quantity of what? A fixed quantity of underlying asset at agreed price on a future date, and settlement will be on a future date, and this date is known as maturity date. So with the help of forward contract, we can what? Prefix the future buying price or future selling price of an underlying asset of a fixed quantity at a agreed price decided today, or the settlement of which will be made on a later date, on a future date, which is known as maturity date. So we prefix the buying price or selling price of a future date today. That is known as forward contract. Forward contract is such a contract where each term and condition of the contract is made today, but the payment and delivery will be made on a future date. That type of contract is known as forward contract. Most of the forward contracts are privately traded contract. Therefore, those are known as OTC contract. What is OTC contract? That is privately traded contract. They are not purchased or sold in an exchange. So there is no exchange involved. So you cannot find currency forward contract in NSE, BSE or any other exchange. You have to do it privately. This is known as currency forward contract. We know that there are two parties. One is importer, another is exporter. Now in future, importer has to buy dollar or buy foreign currency. In this case, let's take an example, dollar. So he will buy dollar in future. So he wants to fix the future buying price. How he can fix it? He can fix it by buying currency forward. We know that what is buy? Buy means long. So if you will take a long forward position, your risk will be reduced. So an importer normally takes long forward position. Why he takes long forward? Because he has to buy foreign currency in future and he wants to prefix the rate at which he will buy foreign currency. Therefore, this is known as long forward. Okay. And what is the position of an exporter? Exporter will sell foreign currency. Why he will sell foreign currency? He will receive foreign currency. Suppose Infosys is a company. Infosys sell its softwares and he received $1 lakh. The $1 lakh he will convert it into rupee. He will sell dollar and receive rupee. So exporter has to sell foreign currency. So he wants to fix future selling price. How he will fix future selling price? He can fix future selling price with the help of selling forward contract. What is selling forward contract? Selling forward means sell means short position. So he can take short forward. With the help of short forward, and exporter can reduce his risk. In order to reduce risk, the importer will go for long forward and exporter will go for short forward. This is the position of currency forward contract. Okay. Okay, this is the payoff diagram of forward contract. Suppose you have fixed the 80 rupees as your agreed price for the contract. Okay, if the price moves beyond 80 or above 80, in one case you will make profit, in other case you will make loss. Okay. So if you have taken long position, what will happen? If you have taken long position, it means you have prefixed the buying price at 80. If you have prefixed the buying price at 80, what will be your position? If you have prefixed the buying price at 80, if the price becomes 79, then you will gain. Or if the price becomes 80, you have fixed 81, you will lose. This is the case. So this is the payoff diagram of a short forward contract. Here he has fixed the selling price at 80. If there is 81, there is loss. If there is 82, there is loss. If there is 83, there will be loss. So this is the loss area. And this will be the profit area. This is the payoff diagram of a short forward. If there will be a long forward, how the payoff diagram will be? The payoff diagram will be just the opposite. This is the payoff diagram of a long forward position. Okay, this will be loss area and this will be profit area. Am I clear? So this is the payoff of a long forward and short forward. Next we will discuss currency futures contract. What is currency future? We know that currency forward and currency futures. In case of forward contract, there are certain limitations. What are the limitations of forward contract? The most important limitation of forward contract is forward contracts are subjects to exchange rate, subjects to default risk. In case of forward contract, the contract is between buyer and seller. If the buyer and seller default in that contract, that is known as default risk or counterparty risk. All the forward contracts are subject to counterparty risk. Forward contracts are bilateral contract, customized contract. Hence, these cannot be purchased and sold once it is made. Hence, forward contracts are illiquid contract. In order to avoid this, a new type of contract comes that is known as futures contract. So we will discuss now currency futures contract. There is no difference between forward and futures. Only those forward contracts which are standardized and purchased and sold in an exchange or exchange traded are known as future contract. That means future contracts are standardized forward contracts which are purchased and sold in an exchange, in a recognized exchange, that is known as futures contract. So the main point of difference between forward and futures is all future contracts are forward contracts, but all forward contracts are not future contracts. Only those forward contracts which are standardized and purchased and sold in an exchange, those are known as futures contract. So a future contract is a exchange traded standardized version of a forward contract. It is traded through a clearing house of the exchange. And in this case, the exchange act as a counterparty for buyer and seller. For buyer, the other party is exchange. For seller, the other party is exchange. Exchange act as a middleman between buyer and seller. Exchange gives guarantee that if buyer does not oblige his obligation, exchange will oblige him. And if seller does not oblige his obligation, exchange will oblige it. So exchange act as a counterparty. Thereby, exchange reduces the default risk or counterparty risk. Okay. Currency futures are also used to fix the future buying rate and selling rate. We know the importer will take what position in currency future? Long position in currency futures to reduce its risk. Long position in currency futures. Similarly, an exporter will use short position in currency future. What is long position? What is short position? We have already discussed. Long position means he will buy currency future. An importer will buy currency future to reduce his exchange rate risk. And exporter will sell currency future to reduce his exchange rate risk. There, okay. So currency futures are purchased and sold in an recognized exchange. Now we will discuss the main point of difference between currency forward and currency futures. What is the difference? We know that currency forwards are privately traded. Privately traded, these are OTC contract, privately traded contract or over the counter trade contract. And these are purchased and sold in an exchange, futures. So these are exchange traded contract. In case of currency forward, the term and conditions of the contract are customized, decided by buyer and seller. Decided by buyer and seller. And in case of future, the term and conditions are standardized. Standardized means decided by exchange. Exchange decide all the term and condition of the contract. Only buyer and seller trade and fix the price. All other things have been fixed by the exchange. So futures are standardized contract. Forwards are customized contract. Okay. Then in case of futures, exchange collect a safety deposit amount from both buyer and seller. And this safe deposit amount is known as margin. So margin is collected in futures, but margin is not collected in forwards because in case of forward, exchange is not involved. Margin is paid by buyer and seller to whom? To exchange. Okay. In case of forward contract, the counterparty risk is present. Counterparty risk means default risk. There is chance of default. But in case of futures contract, the default risk is eliminated by the clearing house or exchange. Exchange assume the default risk. We know that liquidity in forward contract is very low. It cannot be purchased and sold frequently. But currency, in case of currency futures, liquidity is very high. It is purchased and sold frequently. So this is the main point of difference between currency forward and currency futures contract. Okay. Next, we will discuss hedging with futures. We know that an importer will go for long hedge and exporter will go for short hedge. This is the hedging technique. Why anybody who wants to fix future buying price, he will go for long hedge. Hedging means purchasing derivative contract or entering derivative contract to reduce your risk. So importer normally go for long hedge. So long hedge is taken by those party who has foreign currency payable. What is foreign currency payable? You have to pay the amount in foreign currency. If you have to pay something in foreign currency, you will buy foreign currency in futures. When you buy, your risk is future buying price will increase. How you reduce it? You reduce it by purchasing or buying currency futures or by taking long hedge on currency futures. So anybody who has foreign currency payable, he will go for long hedge. Just the opposite. Anyone who will have foreign currency receivable. What is foreign currency receivable? Foreign currency receivable means you have to receive foreign currency. You have foreign currency receivable. You will receive foreign currency like exporter. Once you receive it, you will sell foreign currency in future. You think that future selling price will be less. This is your risk. How you can reduce it? You fix the future selling price. How you can do it? By selling currency futures, or you go for short hedge on currency futures. This is hedging techniques, long hedge and short hedge. Next we will go for next currency option. What is an option? An option means a choice. Choice means right, not an obligation. So in this case, you will make contract not to fix the buying price but selling price. Here you will buy or sell. It's choice. Choice to buy or choice to sell. Choice to buy means if you want to buy, you will buy. If you will not want, there is no compulsion. What is choice to sell? Choice to sell means if you want to sell, you will sell. If you do not sell, there is no problem. That is known as option. So option means right, not an obligation. But right and not an obligation means choice. The choice is to buy or sell what? An underlying asset at a certain date, at a future date. That date is known as expiry date. At a specified price, that price is known as strike price. So in a option contract, you will buy or sell a choice. The choice may be to buy an underlying asset or sell an underlying asset. Okay, at a price. The price is fixed, specified price. That price is known as strike price. On a future date, that date is known as specified date, expiry date. So the choice may be of two types. One is choice to buy, another is choice to sell. If there is a choice to buy, that is known as call option. And if it is a choice to sell, that is known as put option. So what is call option and put option? The call option gives a choice to buy. Call option gives a choice to buy, and put option gives a choice to sell. Choice to buy, call option; choice to sell, put option. With the help of call option, what you can do, you can fix maximum buying price. कॉल ऑप्शन आप अगर खरीदेंगे तो व्हाट विल यू विल डू, यू विल फिक्स, व्हाट यू विल फिक्स, मैक्सिमम बाइंग प्राइस, कौन से रेट पर आप मैक्सिमम बाय करें. हियर इट इज यूज्ड टू फिक्स मैक्सिमम बाइंग प्राइस. If the price is below that, you will purchase at that below price. If the price is above that, you will buy at that price. Okay, that is call option. Call option gives the holder to fix the maximum buying price. So what is put option? Put option gives the holder, with the help of put option, you can fix the minimum selling price. So two things are there. With call option, you fix maximum buying price. With put option, you fix minimum selling price. What is minimum selling price? If the minimum selling price is 8, if you get a chance to sell it at 9, you will sell at 9. But if it is 7, you will sell it at 8. So with the help of call option, you can fix maximum buying price. With the help of put option, you can fix minimum selling price. Okay, and options may be of two styles. One is American option, another is European option. American option can be exercised on any die prior to expiry, but European option can only be exercised only on the expiry date. You cannot exercise an European option any day prior to maturity date. It has to be exercised on a expiry date. Okay, the options may be of two types. Options may be exchange traded option or OTC option. What is exchange traded option? It is purchased and sold in an exchange. What is OTC option? OTC options are traded privately, and these are traded in an exchange. So we know there are two type of option: call option, put option. Call option gives the buyer the right but the obligation to buy. Call options are used to fix maximum which price, buying price. What is a put option? Put option is an option that gives the right, not an obligation, to sell the underlying currency on expiry, and it is used to fix the minimum selling price. Now please see, the importer has to buy foreign currency. So importer will go for long call, and exporter, we have to sell the foreign currency, and exporter will go for long put. These are the hedging strategy. With option, if you are importer, if you are foreign currency payable, you will go for long call. If you are foreign currency receivable, you will go for long put. Foreign currency payable, long call. Foreign currency receivable, long put. Okay, with the help of these two strategy, you can reduce your foreign currency risk with the help of option. Okay, next we will discuss next and the last derivative contract, that is swap. So what is swap? Swap means exchange. Swap means exchange. Swaps are OTC derivative contracts. With the help of currency swap, there is an agreement. What is an agreement? Agreement is between two parties to exchange a sequence of cash flow for a set period. With the help of currency swap, there are currency swap is privately made agreement. It is an agreement between two parties. It is an agreement to exchange a series of cash flow. Series of cash flow means there will be exchange of 5-10 cash flows. Cash flow 1, cash flow 2, cash flow 3. There are two parties, A and B. There are 8-10 cash flows which will be exchanged on different days. It will pay this, it will pay this, it will pay this, it will pay this. There will be exchange of cash flows. Okay. Now, currency swap allow the holder to swap financial flow associated with two different currencies. They involve exchanging interest rate in one currency for another currency. It helps the parties involved in swap to get loans at lower interest rate. So foreign currency swaps are used by those parties which has foreign currency receivable or foreign currency payable. Now please see, in a forward contract, the exchange is done once. Forward contract, cash flow exchange is done once. Cash flow exchange done once. एक बार settlement होता है forward contract. Settlement done once. But in case of swap contract, a string of cash flow. String of cash flow. String means many. Many times cash flows are exchanged. So I can tell swap is a string of forward contract. एक forward contract, एक swap contract consists many forward contract. A currency swap contract may consist 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 currency forward contract. If many forward contracts put together in one instrument and that instrument is purchased and sold at a time, that is known as currency swap contract. Okay, so with the help of currency swap, we can manage the exchange rate risk. So in my class, we have discussed regarding, let me summarize my discussion today. We have discussed regarding derivatives. I have discussed derivatives are financial contract which derive its value from the underlying assets. Then we have discussed there are 4 types of derivatives: future, options, swaps, forwards. Forward, future, option, swaps. In option, there can be call option or put option. We have discussed all those things, and these are certain self-assessment questions. First, what is a derivative contract? What is mark to market or daily settlement of loss in case of currency future contract? What is the relationship between premium in case of put option? What is a swap contract? All these things we have discussed. You can solve these practical problems at home. These are the future readings for knowing more on currency forward, future, options, and swaps. Thank you. Thank you for attending my class today. Thank you all. Thank you.